All right, folks, in this video, I want to go over some general tips for options trading to help you guys to make better decisions. All right, so let's go over a couple of things. Firstly, options trading and stock trading are definitely not exactly the same. In this room, we focus on directional trades where we look for stocks to go up or down, and we use options contracts as the means by which, if we're doing the options program, as the means by which we exploit the movement in price of a stock. Now, of course, if we think a stock should go up, then we would buy call options. And if we think a stock should go down, of course, we would buy put options. And that's pretty basic. Now, there's several things that you need to consider about options. One of the things is delta. If you look here on my screen, you can see that there's a category for what's called delta. And let me see if I can draw a highlight here. Give me 1 second. Actually, I won't be able to, but I'll just circle it with my mouse. So delta is right here. That's the value of how much a dollar move of the stock will be worth for your option. So if the delta says 0.18 or 0.16, what it means is that if you multiply that number times the amount of movement of the stock, that gives you the equivalent value of the movement. So if the stock moved $1 and my delta is 0.18, then that means that will change the value of my option by 18 cents. Now, delta is not constant, it does change, but for the most part, for the type of trading we're doing, you don't have to worry about that. Delta will just be essentially what it is for you. Now, what that means is if I look at a stock, let's say I'm looking at the QQQ ETF. So let's zoom in here on the chart so I can see it. There's the QQQ ETF, right? I'm going to change the stock symbol here to QQQ. Now I'm seeing quotes on the options chain, which I got from right here. Clicking this button here gives me the options chain, and it shows me some options for the QQQ ETF. And over here I have my order entry window, which is coming from right there, and that allows me to place trades. Of course, we covered that in another video. Now, if I were buying options on the QQQ, let's say it was when this was happening right here, and I believe that the QQQ ETF was going to go up by at least a few dollars, then I could buy some call options. Now, maybe I look at it and I say, which call options should I buy? Now, if I buy the options that expire today, October 25th, when I'm recording this video, I have to factor in that there's time decay going on today. An option that expires today is going to have a very, very, very rapid pace of time decay, which means if the stock doesn't move in my direction, if it just stands still, my option will actually lose a lot of its value just from the fact that the stock is not moving in my direction. Because remember, an option that expires, if it's not in the money, it's going to expire with no value. So if I'm buying an at the money option on an expiration day, that means that if the stock doesn't really move in my direction, even if I buy an in the money option, whatever time value I have, I'm going to lose all of it, 100% of it, by the end of the day if the stock doesn't move in my direction. And of course, it's going to have to move substantially in my direction, of course, to overcome the cost. So if I'm paying 74 cents per option for these 496 calls that I have highlighted, there's my ask price right there. If I'm paying 72 cents per share, which is $72 per option, then that means I would need the QQQ ETF to move up far enough to where it will exceed the amount that I just paid for it if I end up having to hold that trade for the rest of the day. So if the delta is 0.4, that means that I would need the stock to move about $2 a share to make sure that the amount that I earn from buying that option will exceed the cost that I paid for it. But it wouldn't exceed it by much. If I bought it for 72 cents and the stock goes $2 in my favor, I might only make $80. So that's only barely more than what I paid for those options. So I would definitely want to make a lot more than that. So one of the reasons why you have to be very careful about trading options that are expiring the same day or within a few days, is that time decay is going to have a massive impact on the price. On a Friday, an option will lose 100% of its time value. On a Thursday, it usually loses about 50% of its time value. So therefore, I need to make sure that if I'm trading options on an expiration day, I'm catching the market when it's on a very rapid pace move up, and I want to get out quickly when things start to slow down. And I also have to factor in my delta to make sure that that delta is high enough where I'm going to make a significant profit. Now, you probably notice as I've been speaking, this delta value has gone up dramatically. That's another characteristic that's common for options that are close to expiration. They'll see their delta value change very quickly. There's a reason for that. I'm not going to get into the specific reason, but when you have an option that's really close to expiration or it's expiring the same day, its delta value is going to change very rapidly. Now, that works in your favor when the market's going your way, meaning that if the stock starts to go in your direction, delta increases fast, and it's going to mean that the movement of the stock is going to have an accelerated gain for you beyond what the delta was when you started. If it goes against you, that means that, as always with options, they have an asymmetric return. So when the market goes against you, the delta value is going to decline to the point where it's going to become close to zero, which means that the movement against you won't count for much. But still, if you paid 72 cents for those options, you really, really, really want to make sure that the movement you're looking for should substantially go beyond the amount that you paid. So in other words, if you paid 72 cents for it, you definitely want to make over a dollar. You want the options to be worth more than $1.40 or double what you paid to really make it worthwhile. So if you're trading on expiration or near expiration, the same week of expiration with an option, you must be in a situation where those options should be worth, I would say, at least double what they are now. So if you pay 72 cents for them, you want them to literally be worth, you want to see at least a double return of what you paid. So that means that you would add $1.42 on top of the 70, $1.44 on top of the 72 cents, or meaning that you should see about, if I buy a 72 cents option, I want to see its value go to basically $2 and change to really make it worth my while. So the other alternative is, instead of trading the options that expire the same week, is to trade options that expire 2 to 3 weeks out. So in other words, if we were trading today, October 28th, 29th, and 30th would be, these are, I forgot, QQQ options expire at shorter intervals. So basically we'd be looking at October 28th, then we'd be going into somewhere in November, etc. Right? So we'd be looking we're looking 1 week out to 1 week, they'd be expiring the next week up to 3 weeks later, right? That would be the ideal options to trade in most cases, right? If you trade options on the same expiration date, you have to be very disciplined and consistent. If you struggle with that, then you need to start trading options that expire 1 week to 3 weeks out. You don't want it to be too far out, because if it's too far in the future, like months, the options are not going to be very liquid, which means they're going to have very wide bid-ask spreads, which means when you get into the option, you're going to have if you sell them, you're going to have a bid that's way lower than the ask you just bought. So let's say you have an option spread. Let's go to a stock that probably has a wide option spread. Let's go to AVGO. All right, so AVGO actually is not so bad. But if I look at the next week options, here you go. So actually, this is not too bad. It's only 10 cents between the bid ask. That's not so bad. Let's try Lululemon. That probably will be a better illustration. So let's see, Lululemon. Here we go. Lululemon. We have options. We have options trading. Hold on for 1 second. So basically, we have options that have a 30 cents bid-ask spread difference, right? 550 at 580. So that means if I get into a trade, that's going to make me lose 30 cents per share right from the entry. In other words, if I buy at 580 and then something makes me change my mind and I sell, I'm immediately losing the distance between where I just got in and where the current bid is. So the wider it is, the more I'm losing. Now, since options cannot be scaled to a smaller size than the 100 share leverage, that means that I have to lose 30 cents a share. So if my risk tolerance for trades is, let's say, $50, then that means if I do this trade, I'm already losing 60% right from the start of what I can afford to lose. That's way too much. And of course, if the stock goes downwards, then this call option is going to, the bid's going to drop even lower, which means now, instead of me being able to get out at 550, now I'm getting out at 545, so that's even worse. So in short, the bid-ask spread is the other thing we have to make sure we're focusing on. We have to look at the options before we get in to make sure the spread between the bid and the ask is not too large. Simply put, for most of us, we can't afford to do options where the bid-ask spread is 30 cents or greater. In most cases, the most you can really reasonably tolerate for a bid-ask spread is 20 cents or less. So if you're looking at options that have that wide of a spread, my strong recommendation is just to ignore them, because even if you're good at trading, most likely you're not going to be able to effectively manage this trade with a bid-ask spread that wide. Okay? And there's no guarantee if you put a trade in at the middle price or somewhere in between that bid and ask spread. Like in other words, let's say you see the bid-ask spread here and you say, well, I don't want to buy at 570. Let me try to buy at 560. Maybe you get filled on that, but if the market's moving, which is the reason why we're getting to a trade, most likely the spread's getting wider. So if the spread gets wider whenever the market moves, which is usually what happens, that's going to make it harder for us to get filled at that middle price. So that's another point. Whenever the market is actively moving, which is exactly the times that we're looking to get into these stocks, that's always going to make the bid-ask spread wider. The only time it's not wider is when the stock is calm and not doing anything. Since we like to get in exactly at the point where the stock starts to show momentum and start to move up or down if we're looking at puts, then that means that the timing of our entry is going to actually affect the degree to which we can get into a stock or options trade without paying too much to the bid-ask spread. So therefore, Lululemon almost certainly is not going to work, because right now the stock is trading fairly slowly, and yet we still have a 20 cents wide bid-ask spread. So the moment this stock starts to move, the bid-ask spread is going to get wider, and therefore we're going to have to accept a larger degree of loss at the entry. So in short, whenever you get into a trade, you're buying at the market price, and if the market price to buy is significantly higher than the market price to sell, then we're going to have an instant loss on our trade that we'll have to accept as being a discount against whatever profits we have. So we're making a profit and the price of the options are going up. When it's time to sell, that spread is 20 cents wide. We're going to lose 20 cents per share off of whatever profit we have. That brings up another point. When we are looking at our options quotations for P&L, we need to make sure that the P&L is actually quoted in the right way. So when I go here to General, and it says here, calculate unrealized P&L against what? I have options bid-ask price. The reason why you want this is because if you base your profit on the last traded price of an option, that last traded price was at the ask. So therefore, if someone bought at the ask and it's 171 for Microsoft, which is what I'm sorry, for Lululemon, which we see right here, if they bought at 170 and I think, oh, they bought at 170, that was the last price they traded, and I can sell because I bought at 150, it shows that I'm up 20 cents at that moment. But as soon as I hit sell, I'm not selling at 170, I'm selling at 130. So now I'm going to go from seeing a 20 cents profit to seeing a 20 cents loss. So again, if I bought these options for Lulu that we're looking at the quotes for right now at $1.50, and the current last traded price was at $1.70, which it was just a second ago when we were looking at this. If that's where the last trade was, and I hit sell to sell my options, I can't sell at the offer price. I'll be selling at the bid. Right now the bid's at 112. So now it's even worse. Notice how far these are swinging. We saw at 170 a second ago. Now it's at 130, and the bid's now at 110. It was at 130 just a second ago. So if I'm trading these options, this could get even worse, because if this bid gets taken out, Now the next one's at 95 cents. So this is why Lululemon is not a good place to trade options, because if I get into this, even if it shows I'm at a profit, I can't get out at that profit. And if it shows I'm at a loss because the last trade was at 134 and I say, okay, I'll sell, I'm not selling at 134, I'm selling at $1.10. Options are not quite as active in trading as stocks are. They take much, much longer for trades to take place. And as a result of that, you could have minutes, even hours going by before an option actually trades again. You can buy it at the current offer price, but when it's time to sell, you may have noticed that the actual price of the options has dropped substantially from where it was when you last got in, but there were no trades that took place. It's very important to understand that with stocks, you have trades happening nearly all the time. So whatever you see as the current quote bid-ask spread for Lulu, that's most likely where the last transactions took place for the stock, which means if you see that you're up at, and the last trade was at 428.10, when you hit sell, you're not going to be able to sell at 428.10, but you're not going to sell much farther behind that. It'll probably be about 10 cents lower, okay, which is significant, but not as bad as seeing the last trade at 157, but then you sell and you're selling at 111. So since options tend to have fewer trades, there are going to be huge discrepancies that can occur between what you see as the last traded price that the option did and where you're able to get out. Because if the market moves and the quotes change, just like we just saw for Lulu, then we have to base our expectation where to exit based on the bid-ask spread. And that's why we have to turn our settings on to show our general quotes, showing that the options are quoted based on the bid-ask price. So that means when you see where your open P&L is, it's actually based upon the current quote, even if no trades took place. Because if the stock price is moving up or down, the quotations for the options will move with it, even if no trades have actually occurred for those options. So therefore, you always want your quotes to be based on the bid-ask spread, not based upon the last traded price. Now, I've gone over a lot of things about options that you need to know, and there are a lot more things that you should know as well. But I've gone over some of the essentials that are the most important to remember. Also remember, as I mentioned in that video about stop losses that we place on options, they only trigger when a trade takes place, which means if you bought this option for Lulu at $1.50, if these options have not had a single transaction since then, and the quoted price goes down, your stop loss cannot actually trigger, even though your P&L is beyond the loss parameter that you set. And again, the reason why is the stop loss is triggered based upon the last traded price. So you might say, that doesn't make sense. Why doesn't it trigger based on the quoted price? The reason why is because a lot of times options quotes are very volatile, and you'll have situations where all of a sudden the bid price drops sharply, then it goes right back to where it was before. Just like we just saw with the offer price for Lulu, for a second it was at $1.70, and then it went right back to $1.50. So if our stop losses are triggered based upon the quoted price, then we're likely to see us getting stopped out, not because the price of the stock moved, but simply because the quotes are irregular and they changed to a drop the bid for a second, where the bid price suddenly drops from $1.30 to 95 cents because someone canceled their bid, and then they re-enter it a second later at $1.32. But because it was missing for that moment, and the next bid was at 95 cents, the stop loss would trigger exit us at 95 cents when we could have actually gotten out if we waited just a second at the more appropriate price. Simply put, stop losses that are triggered based upon last traded price is the norm. That's how it's done for stocks as well. It's based on the last traded price. So since options may not trade for a while, you could have a situation where your stop loss is never triggered, but the quoted price is well beyond your stop loss. You must be aware of that to be safe, okay? So that concludes everything that I think I need to share about some best practice tips for using options. Obviously, there are other things that you may think of or that may come up. Feel free to ask in the coaching room, and we'll be sure to help you with that. Thanks, guys.